All right, today we're going to navigate the pretty complex but absolutely critical legal world that keeps global trade afloat. We're going to be looking at it through the lens of the Indian Marine Insurance Act of 1963, which is basically the rule book for how almost everything you own gets from one side of the world to the other.
I mean, seriously, stop and think about that for a second. Over 90%. Your phone, your clothes, the food in your fridge, chances are it all spent some serious time on a massive ship. So what's the invisible safety net that protects all that stuff from the, perils of the sea? You guessed it, marine insurance. So let's dive right in.
So here's our game plan. We're going to start with the absolute basics, the core ideas behind any kind of insurance. Then we'll see how those rules get a special twist for the maritime world. After that, we'll check out the different types of policies you can get. And finally, we'll get into the nitty-gritty, the fine print that really makes all of this work. Okay, first up, the bedrock of insurance. Before we can even think about setting sail, we got to know what ground we're standing on. These are the fundamental concepts that are true whether you're insuring your car, your house, or a gigantic container ship. Every single insurance contract, and I mean every single one, is built on these 6 principles. They're what keep the system fair. Now, we're not going to get bogged down in all of them today. We're going to focus on the 2 most important ones for our journey, insurable interest and indemnity. So what on earth is insurable interest? Well, it's actually pretty simple. It just means you have to have some skin in the game. You need to have a financial stake. You can insure your shipment of goods because if it sinks, you lose money. What you can't do is insure your competitor's shipment, hoping it sinks so you can cash in. No financial stake, no policy. Simple as that. And that leads us right to the principle of indemnity. See, the whole point of insurance isn't to make you rich, it's to make you whole again. If your insured cargo was worth $100,000 and it's lost, insurance is there to get you back to that $100,000, not to give you $200,000. Think of it like a financial reset button, not a winning lottery ticket. Okay, so we've got those core ideas down. Now let's get into the really interesting stuff, navigating marine insurance. This is where we see how those general rules get adapted for the, let's say, unique and unpredictable world of a marine adventure. You know, I just love the official language here. The Act doesn't call it a shipping problem or a cargo issue. It's a marine adventure. That just perfectly captures the risk, the romance, and the reality of sending something valuable out onto the open ocean, but, in a legally binding way. Now, this is a huge difference, so pay attention. Remember insurable interest? Well, marine insurance has this really important twist. With most other kinds of insurance, you need to have that financial stake right when you buy the policy. But at sea, things move fast. You only have to prove you had an interest at the moment of the loss. This is absolutely vital because cargo can be bought and sold multiple times while it's still on the water. All right, let's move on to our third section, a policy for every port. Look, not all voyages are the same, so it makes sense that not all insurance policies are the same either. Let's check out some of the different flavors of coverage you can get. So you've got a whole menu of options here. Some cover a single trip, others cover a set amount of time, and some even let you agree on the value of your stuff up front. We're going to zoom in on the most common ones. First up, the Voyage policy. And yeah, it's pretty much exactly what it sounds like. Your stuff is covered for one specific journey from point A to point B. Say, a shipment from Madras to Singapore. Once it gets there safely, the policy's job is done. The coverage is all about the geography of the trip. And on the flip side of that, you have the time policy. This isn't about the journey at all, it's about the clock. It covers you for a set period, like 1 year. This is what you typically use to insure the ship itself, the hull, the engines, because it's constantly making all sorts of different voyages. So let's just boil it down. A voyage policy is all about where you're going. A time policy is all about how long you're covered. One is about distance, the other is about duration. Just 2 different tools for 2 very different jobs. Now this one, the valued policy, is super important. What happens here is that you and the insurance company agree on the value of the cargo before the ship even leaves the port. This is a game changer because it prevents any arguments later about what the stuff was actually worth. Barring any fraud, that number is set in stone. All right, time for our final section, decoding the fine print. This is where things get really practical. Believe me, these clauses aren't just boring legal jargon. They are solutions to real problems that have been figured out over hundreds of years of things going wrong at sea. So let's play out a scenario. Imagine your containers are halfway across the ocean and you get a great offer from a buyer. You make the sale. But what about the insurance? Does it just poof disappear?
The answer is no, thankfully, because of something called the assignment clause. This is a perfect example of how flexible this area of law is. It lets the insurance policy travel with the goods. You can literally assign it to the new owner. Without this little clause, global commerce would grind to a halt. It's that important.
Okay, scenario number 2. Your ship is on a straight path from London to New York, but a monster hurricane pops up right in the way. The captain, being a smart person, decides to go around it, which adds a few days to the trip. Is your insurance now void because you didn't stick to the plan? And again, the law has an answer for that. It's the change of voyage or deviation clause. It basically says, hey, we get it. Stuff happens at sea. As long as the captain's reason for changing course is a good one, like saving the ship or even helping another vessel in distress, the insurance coverage stays in place. It's all about being reasonable. One last one for you. Let's say a small fire breaks out in one of your containers. As the owner of that cargo, are you supposed to just grab some popcorn, watch it burn, and think, don't worry about it, it's insured? Absolutely not. The sue and labor clause says that you actually have a duty to do everything you reasonably can to prevent or minimize the damage. But here's the cool part. The insurer agrees to pay you back for the costs of trying to save the day. So it creates this kind of partnership where everyone is working together to make the loss as small as possible. It just makes sense. So when you zoom out and look at the whole picture, you see that all these pieces, from big ideas like indemnity down to the nitty-gritty details of an assignment clause, they all fit together to create this invisible but incredibly powerful framework. This is the legal engine that gives companies the confidence to ship trillions of dollars worth of stuff across our oceans every single year.
But that leaves us with one final big question. Most of these rules we've talked about are based on laws that are over 60 years old. In a world with new challenges like climate change, cyber attacks, and sophisticated piracy, how will this old framework hold up against a whole new generation of marine ventures? It's definitely something to think about.